Well, let's turn our attention to the oil and gas space. Dayanand Mittal, the oil and gas analyst at JM Financial Institutional, joins us on the show. Hi, Dayanand. Good morning and good to see you. And thanks a lot for joining on the show. We've seen a bit of a bounce in oil prices, according to the sheet that you all put together. What kind of range are you working with? First on Brent crude prices.
Yeah, thanks, Nigel. Good morning. So our view has been that the recent correction in oil price was more on account of exaggeration of the weakness in Chinese demand. So Chinese demand has been soft, but nowhere it has collapsed. So instead of global oil demand growing at about 1 million barrel per day or about 1%, it has been cut by about 10 to 20 basis points. But still oil demand growth is robust at about 0.8% or so, which in no way is a shocker. So the recent collapse in our view was more due to a lot of speculative activity which takes place in commodities, and hence it was an exaggeration of that. Our view on crude price is based on the presumption that OPEC Plus still continues to have a very strong pricing power, primarily because OPEC Plus during COVID times had cut output by 10 million barrels per day. As of now, they've cut output by still about 5.5 million barrels per day. So they have enough headroom to cut further in case there's a demand shock. And second, US crude production has not been rising despite the very high oil price we have seen over the last few years. This is because of a lot of ESG concerns, unavailability of equipments, and more importantly, US oil companies becoming more sanguine and focusing on ROC rather than just simply on growth. And hence, OPEC Plus, we believe, will continue to have a very strong pricing power, and they will try using that to ensure crude stays around that $80 per barrel level, which is a fiscal break-even for Saudi. So views continues to be around that level. That Brent will stay around that $80 per barrel. It will not spike beyond 85, 90, given the lot of demand concern, and fairly so. So yeah, around $80 is what we think where it will stabilize at.
Okay, interesting. Dayanand, thanks for neatly putting that together. Then how do you approach stocks? If you believe that Brent is going to be holding at around $80 per barrel, will you look to buy into ONGC and Oil India, which weakened a little bit in the last month or so, but from the recent close, they've bounced well as well?
Yeah, that's exactly our view. So we have put out a note last week highlighting that same thought, that we continue to prefer the upstream company, particularly Oil India, given the very strong production growth outlook over the next 2-3 years, about 30-40%. And also ONGC, given about 12 to 15% cumulative production growth outlook over the next 2-3 years. As we all know, because of windfall tax, their realization is capped at 75. So anything above 75 gives market that comfort that 75 net realization is here to stay. So and valuations also, though all the PSUs have rallied, but here in upstream companies case, both ONGC Oil India valuation are still in a reasonable zone. And hence we prefer ONGC Oil India over the OMCs, where we believe probably valuations are a bit stretched, and also refining margin, we are not as bullish about refining margin as many in the streets are. And marketing margin, the current high marketing margin, we believe is not a sustainable one. It might stay for a couple of months, a couple of quarters, but yeah, it's not sustainable. So one should not bake that in future estimates.
Got it. All right. What about how do you approach the OMCs? The fear is that we have a couple of big state elections coming about. Crude oil prices have been a little bit weak as well. And that's what could weigh on these counters. Your take?
Yeah, so as highlighted, so we believe the current high marketing margin which they're making, which is 6, 7, 8 rupees above the historical margin that they earn, that is not sustainable. It's just a matter of few months, quarter here and there, when government either cuts fuel prices or in our view, most likely they will hike excise duty. They would not like to preempt crude price and take a fuel price cut, given we all know crude is highly volatile, geopolitical tensions are pretty elevated, so crude can bounce back any moment. So reversing fuel price cuts in India might be a challenge. So safer move for the government might be to go for an excise duty cut and some marginal fuel price cut. Yes, elections are around the corner, but as you know, it's just in a couple of states. So doing a pan-India cut may not be the most likely move, or if any, it might be a limited couple of rupees only, I guess.
So preference is more for the producers rather than these oil marketing companies, it seems. Anything else you like with regard to the oil and gas space? Any big calls, buy or sell recommendations from the space, besides the names we've already discussed?
Yeah, so in the gas names, we like Gujarat Gas among the CGD space, particularly because we believe spot LNG prices in the medium to long term are likely to moderate from current 16-17% of crude. It might moderate to more like 10-12% because a huge LNG supply capacity addition which is happening globally, particularly in Qatar and US starting CY26. And hence, moderation in spot LNG price boosts competitiveness of Gujarat Gas business model versus propane. So that stock we like. We also like GAIL, given the gas transmission business is doing relatively well after a tariff hike last year. Plus, India's gas consumption is likely to grow at 5-6% CAGR. The gas trading business is doing relatively quite good. So we like GAIL as well. And overall, Reliance, though, is not purely oil and gas, but yeah, we like Reliance with more due to telecom and retail business.
Okay, all right, Dayanand, we appreciate you joining in and helping us out with your analysis of the sector. Wishing you a good day ahead, and we look forward to chatting up with you in the near future.